Mortgage rates are rising again, but this time the reason is not just the Federal Reserve, it is not just inflation. There is a hidden feedback loop happening inside the mortgage market, and it may be making mortgage rate even worse. The 30-year fixed mortgage rate just climbed to 6.51%. That's a major move for home buyer. But the most important part is not just the mortgage rate number. The important part is what may be happening underneath it. When mortgage rate rise, fewer people refinance. And when fewer people refinance, mortgage bonds last longer. And when mortgage bond lasts longer, big investors have to protect themselves. And one way they protect themselves is by selling treasuries. But when investors sell treasury price fall. And when treasury price fall, treasury yields rise. And when treasury yield rise, mortgage rate rise too. So mortgage rates are not just falling in the bond market. The mortgage market itself may be pushing the bond market even higher. And that is the scary part. So in this video, we're going to break down very simply. First, we'll talk about why mortgage rate jump. Second, we'll explain what mortgage investors are doing behind the scene. Third, we'll explain why this can push treasury yield higher. And finally, we'll talk about what this means for home buyer and anyone waiting for the rates to fall. Let's start with the basic relationship. Mortgage rate usually move with the 10-year treasury yield. They're not the exact same thing, but they're closely connected. The 10-year treasury is one of the most important benchmark for long-term interest rate. So when the 10-year treasury yield rise, mortgage rate usually rise too. And that's what happened. The 30 years fixed mortgage rate just jumped to 6.51%. At the same time, the 10-year treasury also moved higher. So the first part is simple. Treasury yield went up, mortgage rate went up. But that's only the surface level story. The deeper question is, why did treasury move so aggressively? Part of it is inflation fear. Part of it is oil. Part of it is uncertainty around the Fed. But there's also another piece most people do not talk about. Mortgage investors themselves may be adding fuel to the fire. Now, let's talk about mortgage bond. When people get a mortgage, that loan usually does not just sit in one bank forever. Many mortgages get bundled together into something called a mortgage-backed security, MBS. These are bonds backed by mortgage payment. Big investors buy them. Pension funds buy them. Asset management buy them. Banks buy them. And these mortgage bonds are very sensitive to interest rate. And so when you have these mortgage rate fall, homeowners are more likely to refinance. They replace their old higher rate mortgage with a new lower rate mortgage. That means old mortgage get paid off early, so when rate falls, mortgage bond can disappear faster than the investor expected. But when mortgage rate rise, the opposite happen. Homeowners do not refinance. They stay locked out of their old mortgage. That means the mortgage bond lasts longer. And when the bond lasts longer, it becomes more sensitive to interest rate change. That creates a lot of risk for investors. So when the rate rise, mortgage investors suddenly realize, wait a minute, this bond may last much longer than we expected. And now they need to hedge that risk. That's where the feedback loop begins. This is where the technical terms comes in. It is called convexity hedging. Now that sounds complicated, but the idea is actually simple. Mortgage investors are trying to protect themselves from interest rate related risk. When mortgage rates rise, the mortgage bond they own can become longer lasting and basically more sensitive to rates. So investor hedge. One way to hedge is by selling treasury or using treasury related instrument. But when a lot of investors do this at the same time, it can push treasury yield higher, and that creates a loop. Mortgage rate rise, refinance slow down, mortgage bond lasts much longer. Investor hedge it by selling treasury. Then treasury yields rise, mortgage rates rise again, and then the cycle repeat. This is why mortgage market can make a rate move worse. It is not just reacting to higher rate, it can amplify higher rates. So now the question is, why it is happening right now? The answer is that mortgage market is still dealing with the aftershock of the low rate era. A lot of homeowners are locked in extremely low mortgage rate during 2021 and 2020. Some people have mortgage around 3%, some even below 3%. And when today's mortgage is above 6%, those homeowners have almost no reason to refinance. They're locked in. They do not want to give up their low rate, and that means many old mortgage bonds do not get paid off quickly. They stay around longer, and when bond lasts longer than expected, investors have more interest rate risk than they do now. So this is not just a normal rate move. This is the mortgage market adjusting to a very unusual environment. Millions of homeowners are locked into low rate. New buyers are facing much higher rate, and investors are trying to manage the risk in the middle. This is why the Fed does not control the mortgage rate directly. The Fed controls short-term interest rate, but mortgage rate are long-term rates. They're more connected to the bond market, especially the 10-year Treasury. So even if the Fed does not hike, mortgage rate can still rise. The Fed can say, we're holding rates steady, but if Treasury yield rise, mortgage rate can still go up. The Fed can also say, we may cut rate faster. But if inflation fears, oil price, or mortgage hedging push yield higher, mortgage rate may not care. This is why waiting for the Fed is not enough. Homeowners are not waiting on the Fed. They're waiting on the bond market right now. And right now, the bond market is dealing with inflation risk, oil risk, government debt concerns, and this hidden mortgage market feedback loop. That is why mortgage rate can stay sticky even when people expect rate cuts. So what does this mean for home buyers? It means mortgage rate may not fall as quickly as people hope. A lot of people are waiting for the Fed to cut rate, a lot of buyers. But even if the Fed eventually cut, mortgage rate may not instantly collapse because mortgage rate depend on more than just the Fed. They depend on Treasury yield, they depend on inflation expectation, they depend on investor demand for mortgage bond, and finally, they depend on the mortgage spread. And now they also depend on whether or not this hedging feedback loop keep pushing yields higher. If the feedback loop continues, mortgage rate can stay high for longer. That keeps the monthly payment expensive. That keeps affordability under pressure, and that keeps buyer on the sideline. And it can keep the housing market frozen too. So here's the full picture. Mortgage rates are rising again, but this is not just a simple Fed story. It is not just a simple inflation story. There's a hidden feedback loop inside the mortgage market. And when mortgage rate rise, fewer people refinance. And when fewer people refinance, mortgage bond can last much longer. And when the mortgage bond lasts longer, investors have to hedge their risk. And so when investors hedge, they sell Treasury. And that's where Treasury yield can rise even more. And that can push mortgage rate even higher. And that is why mortgage rate can create their own problem. The mortgage market is not just reacting to higher yield. It may be helping push yield higher. And that is why home buyers should not only watch the Fed, they should also watch the 10-year Treasury. They should also watch the inflation data. They should also watch the mortgage spread. And they should also watch whether or not this feedback loop continues. Because if it does, mortgage rate may stay higher and stickier for longer than people expect. So the big question is no longer just when will the Fed cut? The better question is, will the bond market even let the mortgage rate fall? That's all for today. That's my outlook on mortgage rate based on the hidden feedback loop happening inside the mortgage market. Thank you for watching.